Welcome to Breakaway Funding's November webinar. Thank you for coming. We hold these events once each month, bringing you valuable information on a variety of subjects, from using crowdfund investing in your self-directed IRA to today's presentation on investing fundamentals for the 21st century to help you become a more confident and informed investor or a more effective and successful entrepreneur. We hope you enjoy these webinars and will make them a recurring part of your Google or Outlook calendar. And for those of you following along with social media, you can find us at #Invest101. Good morning. My name is Kim Kaselionis. I am the former CEO of Circle Bank, which I built and operated for nearly 2 decades. And I am the founder and managing partner of Breakaway Funding, which was created to step into the void in the private capital market by bringing together investor-ready entrepreneurs seeking funding and community investors like you. A bit about Breakaway. Breakaway Funding is a complete capital raising and investment system. Now, what the heck does that mean? Well, it means that we provide the training, tools, and technology to help entrepreneurs get investor ready. And on behalf of investors, we provide comprehensive and transparent due diligence documentation, analysis tools and education, and the technology platform for you to make informed investment decisions through a secure, convenient, and regulatory compliant website. In short, we are here to help orchestrate economically vibrant and sustainable communities through mutually beneficial relationships between investors, entrepreneurs, and local financial institutions. To help set your expectation, this is our agenda for today. First, I will be talking a little bit about why we believe investor education is important, followed by our featured speaker today, Sexton, who will be talking to us about investing fundamentals, and I will wrap it up with a brief discussion about all things crowdfund investing and what opportunities it presents for you. We have designed these events to be interactive, so please feel free to ask questions at any time during the presentation. To ask a question, use the conversation box on the right-hand side of your screen, and we will get to as many questions as possible. A message from our attorney. I am not a licensed advisor. The opinions and information contained in this material is based on sources believed to be reliable and are written in good faith, but no representation or warranty, expressed or implied, is made as to their accuracy or completeness. Now let's get started. Why should we care about investor education? Well, let's get real. Investing isn't for the faint of heart because it involves risk. Market risk, interest rate risk, inflation risk, and risk of fraud. The list is endless. But those risks can be mitigated through education, planning, and understanding your risk tolerance levels. Now, we all know that there are enduring adages about how to become a successful investor. In the stock market, it's buy low, sell high. In real estate, it's either location, 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 or never sell. And in business, it's sell high margin products or services matched with low capital cost. Well, sure enough, if it were that easy, everyone would do it. But while it's never easy, it's certainly not impossible. Look around you. There are successful businesses, accomplished investors, and wealthy property owners everywhere. So, how do they do it? Well, having spent 2 decades working with businesses investors, I have seen the formula, and it's not a magic one, but it's one that transcends time. Are you ready? Here it is. Be smart about what you are doing. If you're a business, that means know your marketplace, know your competition, and gain access to a diverse source of capital like crowdfunding and hire smart people. If you're an investor, it means know the market segments that you want to invest in, how they stack up in the marketplace, and work with smart people to advise you. Now, while this country lurches from one credit crunch to another, and from one housing bubble to the next, no doubt you've noticed that some people do it better than others. I would make the case that those that do well have a basic understanding about how the markets work, have a long-term investment strategy in place to map their path to financial success, and are comfortable with the fact that all investments involve some element of risk. And because they are knowledgeable about their investments, they understand that success comes mostly to those who have a long-term view. Remember that while almost everyone suffered from the economic crisis beginning 2008, there were those who saw the opportunity and have benefited from rising real estate values and stock market prices. Among the investors who suffered most during that period were those that bailed out early and missed the amazing stock market rally in the 3 years that ended March 2012, a rally that produced nearly a 30% per year return. We recognize that there are those who are successful over time and appear to have core elements in their thinking. They want to be educated about what they own, what they invest in, and employ this knowledge to attain greater returns on their investments while reducing their risk to become a more confident investor. That's why at Breakaway, providing investment education workshops and seminars are intrinsic to how we work with our clients. We want to help you become a more confident, astute, informed, and canny investors. And with that, it is my pleasure to introduce to you today Zoe Sexton. Zoe is a 20-year financial service and branding expert and currently a wealth advisor at the Putney Financial Group in San Rafael. Prior to Putney, she was the managing director at McGuffin LLC, a financial servicing branding firm with offices in San Francisco, Barcelona, and Australia. Zoe is passionate about working with clients, helping them to achieve their personal goals and financial needs as they plan for the future. And along those lines, she will be sharing with us today the basic understanding of investment, what our alternatives are, why investing should be part of your long-term financial strategy, and how investing today can help you achieve your financial sustainability for tomorrow. Good morning, Zoe. It's terrific to have you with us here this morning.
Good morning, Kim, and welcome everyone. My name is Zoe Sexton, and I represent the Putney Financial Group. Thank you, Kim and Breakaway, for hosting me on this webinar, and thanks to all of you who are listening. In this presentation, I'm going to give you a basic overview of investing. I hope this overview will get you thinking about your own investment needs and goals. I wanted to set some expectations for you to pay attention to. I'm just going to go over basic categories and investment types, inflation, which I consider the silent killer, the power of compounding, when to start investing, the relationship between risk and reward, and the strategy of dollar cost averaging, a bit about asset allocation and how it works, diversification and managing risk throughout your portfolio, and finally, the function of a financial advisor. So what does investing mean to you, and what are the consequences? Perhaps you think of investing as speculating or just saving. It's a little bit of both. Consider investing a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but it doesn't have to be difficult. Who can remember the 5-cent ice cream? No, I'm not that old myself, but I've heard about it. I do remember the 25-cent candy bar, and it's not 25 cents anymore. That's inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. Let's say you have $200,000 stashed in your mattress. Assuming a 3% annual inflation rate, what will that $200,000 buy you in 20 years? Just over $108,000 worth of goods and services. But what about 40 years? Less than $60,000. Someone said the safest way to double your money is to fold it over once and put it in your pocket. But if your investments aren't keeping pace with inflation, you're actually losing purchasing power each year. So if inflation is busy reducing the value of your savings, what's the counterpart? Compounding has exactly the opposite effect. Anyone who has a savings account understands the basics of compounding. The funds in your savings account earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value in your account. Basically, you earn interest on your interest. Many people don't fully appreciate the impact the compounded earnings can have, especially over a long period of time. Let's say you invest $5,000 a year for 30 years. If you stuff it all in your mattress, you'll have invested a total of $150,000. But assuming your funds grow at exactly 6% each year, because of compounding, you will have over $395,000. So what does that tell you? The sooner you start investing, the better. Waiting too long can make it very difficult to catch up. Let's just say you're investing a portion of your monthly earnings each month equal to $3,000 a year, and assume a 6% annual growth rate with no tax. How much will you have at age 66 if you started when you were 20 years old? Almost $680,000. So what if you wait till you're age 35? Only about $254,000. And if you wait until age 45, a mere $120,000 by the time you're 66 years old. That's really not enough for retirement, particularly right now. So the first step in any investment plan is to identify your goals. What are you investing for? Some people think the perfect retirement plan is the last check you write bounces. Others want to leave something for the next generation. Investing is different for every individual. The investment that's right for you depends largely on your goals and the comfort level when it comes to risk. The longer your investment time horizon, the more risk you can afford to take. If your investment goals are short-term, then you would want to take on less risk. So what if there was an investment available to you that would either double overnight or you would lose it all by tomorrow? Feels a little bit like Vegas, right? The world of investing is very subjective. The investment plan that's right for you depends largely upon two aspects of risk tolerance: the capacity of the investment plan itself to absorb losses, and your emotional comfort level with risk. Investors are typically grouped into three categories for the purpose of discussing risk tolerance: aggressive, moderate, and conservative. Those who have, with aggressive, a high degree of risk tolerance, and moderate, those who are willing to accept a modest amount of risk, and conservative, those who are very risk adverse. But what does this mean? When it comes to investing, there's a direct relationship between risk and potential return. This is true for investment portfolios as well as individual investments. As the potential for return increases, so does the level of risk. Or stated another way, the less risk an investment has, the lower the potential for return. For example, putting your money into a bank CD may have little risk to principal, but will have greater risk of inflationary loss. This is known as the risk-return trade-off. As much as we would like to have it, we can't have it all. There is a relationship between growth, income, and the stability of our investments. And when we move closer to one, we automatically move away from another. But don't worry, you're in good company. This is a dilemma that all investors face. Let's take a look at some investment options, not the investment vehicles that might contain them. Well, investments might be a mix of some of these 7 options listed here: options and futures, common stock, preferred stock, corporate bonds, government bonds, CDs, or treasury bills. Investment vehicles are IRAs, 401ks, trusts, and they are a topic for another webinar. So let's first talk about cash. It's low risk, short-term, and relatively liquid. It has some advantages of predictable earnings, easy access, little risk to principal, but again, low returns and inflationary risk are big disadvantages. Some examples might include CDs, money market deposit accounts, money market mutual funds, or T-bills. But let's talk about our next level up the risk profile line. Bonds are essentially loans to a corporation or a government, which is why they're called debt instruments. You, the investor, lend money to a government or a corporation in exchange for interest payments at a rate set in advance with the anticipation of having your principal returned to you at a future date from 1 to 30 years. However, bonds don't need to be held until they mature. Once issued, they can be traded like any other type of security and will fluctuate in price in accordance with the shifts in interest rates. That is, if interest rates rise, the price of current bonds will go down. If interest rates go down, the price of bonds will go up. Volatility will affect bonds, and volatility is a statistical term most easily explained as swings in price. Bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks, which I'll explain in a moment, or commodities like oil, metal, or agriculture. But they're an important component of most risk investment portfolios. Bonds may also help you diversify your investment holdings. Bond values tend to move in the opposite direction of the stock market. That means they have a low correlation, moving in opposite directions. By holding both bonds and stocks in your portfolio, you might be able to offset losses in one asset category with gains in another asset category. And finally, because they have relatively lower risk than other investments, they tend to also offer relatively lower returns. So why doesn't everyone run to stocks? Well, what are they? When you buy a company's stock, you're actually buying shares or ownership in that business. A share is typically not much ownership. For example, when you buy 100 shares of IBM, you own 100 millionth of a percent of the company. Not much, right? As a shareholder, you participate in the risk taken and the profits generated by the company. Your share of the earnings or losses will be proportionate to the amount of ownership that you have. There are both preferred stocks and common stocks. In a nutshell, the difference between preferred shareholders is their priority to receive dividends first, but common shareholders are the ones who have the voting rights in the company. Stocks are typically categorized by the market value of the company, which could be large cap, mid cap, small cap, or even not listed here, micro cap. Cap refers to the word capitalization, what funds that company, what keeps it afloat, and how much that company is worth. Large cap companies are greater than $10 billion. Mid cap are $2 billion to $10 billion. Small cap are $800 million to $2 billion. And micro cap companies are early stage companies, usually $50 million to $300 million. Growth stocks are considered to be growing faster than their industry average, while value stocks are selling at a low multiple of their sales. Income or blue chip stocks usually pay good, consistent dividends. And ADRs, if you haven't heard of them, are American Depository Receipts, representing a share of a company held outside the U.S. that is traded on the U.S. stock exchange. There are advantages and disadvantages naturally to owning stocks. And this depends largely upon the individual stock or the type of stocks that you choose. When you buy a stock, you make money in one of two ways: by receiving dividends like profit sharing of earnings, and second, by selling shares. If the value of the company has gone up since you purchased the shares, you will make a profit. Of course, if the value has declined, you will lose money. This can depend on two things: what's going on in the market and whether or not the company itself is performing well. In general, though, stocks offer greater potential for returns than do bonds or cash alternatives. Historically, this has been particularly true for long-term periods. With stock, you actually own a share of the company and have the ownership rights, as I discussed, including voting rights. You can invest in stock that has a long history of paying regular dividends, or you can invest in the stock that has a potential to appreciate in value. And stocks are very easy to buy and sell. Of course, if you invest poorly and the company declines in value, then you're going to suffer the consequences. They're subject to volatility, meaning when you want to sell a stock or access those funds may not be the best time in the market. And of course, there's a greater risk to principal with that concept. Stocks are generally not appropriate for short-term investing unless you have a high degree of tolerance for risk. So how can you get a group of stocks? Well, you might want to buy a mutual fund. The principle behind a mutual fund is quite simple. Your money is pooled along with the money of other investors into a fund, which then invests in certain securities according to a stated investment strategy. The fund is managed by a fund manager who reports to a board of directors. All this sounds very complex, but it offers a degree of regulation and consequences within the industry so that you get what you think you're getting. By investing in the fund, you own a piece of the total portfolio, which could include anywhere from a few dozen to hundreds of securities. This provides you with a convenient way to obtain professional money management and instant diversification that might be more difficult and expensive to achieve on your own. Mutual funds come with prospectuses, so make sure you read through the prospectus before you invest. It will clearly explain what the fund is investing in, tax treatments, and expenses within the fund. We've discussed the three major investment categories of cash alternatives, bonds, and stocks, and many mutual funds limit themselves to just one of these categories. Stock funds can also be classified based on the size of the companies in which they invest. Large cap, mid cap, small cap, as mentioned before. Of course, there are many other types of funds. For example, funds that invest in both bonds and stock are often called balanced funds. In fact, there are mutual funds that fit all along the risk-return spectrum. Even international funds which seek investment opportunities outside the United States. Although the name of a mutual fund may sometimes offer insight into its investment style and objective, please do not rely on the name alone to determine whether a particular fund is what you want. You should read the prospectus before you consider investing. Mutual funds offer several advantages: diversification, professional money management, small investment amounts, and liquidity. Liquidity meaning the degree in which you may buy or sell that into the market without affecting the asset's price, without heavy volume fluctuations. The disadvantages are that the fund price does fluctuate daily. A portion of the fund dollars may be tied up in cash for liquidity needs. It may be tax inefficient, and there may be higher fees and expenses associated within the fund. This you can also find out in the prospectus. There's also another way to buy a basket of stocks. And these are called exchange-traded funds. And like a mutual fund, an exchange-traded fund pools your money with the money of other investors and invests in a collection of securities. However, there are some key differences that you need to understand. Unlike actively managed mutual funds, exchange-traded funds typically select investments according to a specific index. For example, the S&P 500, which is an index. The fund's investment choices are typically limited unless the index itself changes. That passive management style and relatively infrequent trading can help reduce the fund's costs for such things as management fees, research into their individual securities, and the trading fees of buying and selling along the way. In this way, they're a bit like an index mutual fund. But even if ETFs have a passive management style, they can be useful to investors who want to trade actively. For example, an ETF can be traded throughout the day, and its price may fluctuate as a result of that activity, just acting like a stock. This is different from a mutual fund, which is priced only once a day after the market closes. Also, an ETF can be bought on margin, sold short, or traded using stop orders or limit orders, just as a stock can. Selling an investment short means you're predicting the price will go down. There is a more complicated aspect of shorting and options trading, but I am not going to explain it right now. I'd be happy to explain it with you later. ETFs are one way to invest in an individual market segment or industry without limiting yourself to a single stock or bond. And finally, because they trade relatively infrequently, ETFs may offer tax efficiencies. For example, they may make lower taxable annual distributions to shareholders. Like a mutual fund, each ETF publishes a prospectus. Get a copy before investing and carefully review the information it contains. Even if two ETFs invest in the same market segment, you may use indexes that are structured differently. Some people think that money is the root of all evil, but I've found that lack of money is really the root of all evil. As we've discussed, there are many forms that money can be invested in, all of which represent value and can be bought, purchased, or traded. We discussed the three main categories as cash, bonds, and stock, and funds, but there are many other options, including real estate, both commercial and residential, and real estate investment trusts, stock options, futures and commodities, which amount to speculating on the future value of something, like gold, sugar, or wheat, for example. And then there are collectibles, such as antiques, fine art, gold coins, or anything that may appreciate in value over the years. Because this is an investment basics discussion, we're not going to spend any time on these other investments right now, but I'd be happy to discuss them with you in person if you like. But let's spend a moment on how you might invest. What approach should you take? Many mutual fund investors utilize an investment strategy called dollar cost averaging. I've spoken to many people who think they can time the market. Sometimes that might work, but certainly not all the time. I knew a fellow I would bump into on occasion, and he always wanted to talk about the market and know what it was doing. When I asked him if he was investing, he said, no, the market's too high. It had been on the rise for a number of months. The next time I ran into him, I asked if he had been able to capture any of the market run. He said no, he was still waiting for it to go down. Months went by, then years, he had still not invested. Then the market crashed, and that was in 2008 and 2009. It was a great opportunity to get in at low cost, as Kim mentioned earlier in this presentation. When I ran into him again and asked if he'd done anything, he said, no, it's too risky. The market could go lower. What's the moral of this story? The hypothetical illustration above says it all. It's always better to dollar cost average into your investment portfolio because you will always get a better average price over time. There is a mathematical reason for this, but I won't get into it right now. For those of you so inclined, and I encourage you, please download the free workbook at the end of this seminar, and you will find the information on page 12. If you're currently contributing automatically to a 401k plan at work, you're actually already practicing dollar cost averaging. You can do the same thing by dividing the maximum IRA contribution by 12 and contribute an amount monthly. So let's talk about asset allocation. Why would you do it? I like this cartoon because it kind of reminded me of my farm life upbringing, mixed farm, auto repair, financial consulting, and some light puff pastries. Well, it sounds a little odd, but that is diversification. It's become an accepted standard that diversifying your investments improves your chances of investment success. A mix of investments with varying levels of risk helps minimize exposure. Asset allocation is one of the first steps in creating a diversified investment portfolio that has a mix of different investment classes. The underlying principle is to balance risk with reward and the understanding that different asset classes respond differently to the same news. Your stocks may go down while your bonds go up, or vice versa. Diversifying your investments over different asset classes may help you lower the overall volatility of your portfolio. So how do you choose what's right for you? Most allocation models consider a number of variables. Some are objective, like your age, the finances you have available, your time frames, how much liquid cash you need, and some are subjective, your tolerance for risk and your outlook on the economy, basically your emotional state. You'll want to choose a mix of investments that has the potential to provide the return you want at the level of risk you feel comfortable with. For that reason, it often makes sense to work with a financial professional to gauge your risk tolerance, and then tailor a portfolio to your risk profile and financial situation. Every individual situation is unique. Nevertheless, in general, conservative asset allocation models will invest heavily in bonds and cash alternatives with the primary goal of preserving principal. In this moderate allocation, you can see that 50% is invested in stocks. You might think that you have 50% of your investments in stocks, then you would get 50% of the market return. So 50% investment in stocks, you will think that you might get 50% of the market return. I had to say that twice because it's just not true. You actually get 70% of the market return for taking only 50%, one half, of the risk. This is called the efficient portfolio. There is a mathematical reason why it works, which I'm not going to explain right now, but I would be happy to explain it to you in person. And finally, an aggressive asset allocation model will tend to concentrate heavily in stocks, focusing on potential growth. Believe it or not, your investments have been allocated by someone, either advertently or inadvertently. Do you know how your portfolio is set up right now? Is it high risk? Is it moderate risk? Or is it low risk? If you don't know, you should. If you're considering working with a financial advisor, here are some of the questions you ought to be asking. Are you a fiduciary? How are you compensated? What credentials and licenses do you have? How much experience does your firm have? How frequently will we communicate? And how many new clients do you take on each year? This is just a handful of the questions that you ought to ask, and there are many more. But please ask them. As you've seen, there's a lot to consider when it comes to investing. If you don't have time, confidence, or inclination to put together an investment plan, you may benefit from the help and advice of a financial professional. And they can help you determine your investment goals, timelines, and risk tolerance. They can help you evaluate markets and different types of investments. They can help create an asset allocation model that suits you, including alternative investments. If you own real estate, it would fit into your asset allocation model. They'll help you select specific investments, and they will help manage, monitor, and modify your portfolio as needed. I want to thank you for your time. You've been a wonderful audience, and I would welcome the opportunity to meet with each of you to address any specific concerns and questions that you may have. And I want to thank, again, Breakaway and Kim Kaselionis for having me on this webinar and speaking with you. If you have questions, we're open for that now.
Thank you, Zoe. We'll open it up for questions now. If you have a question, please use the question box in your control panel in the upper right-hand corner of your screen and go ahead and type it in, and we'll get to it in order. We have this question for you, Zoe, from Samar. How much do I need to be investing for it to make sense to hire a financial advisor?
That's a very good question. Really, you could hire a financial advisor very inexpensively by opening an IRA and allocating the maximum amount that you can. I think it's $5,500 right now, unless you're older than 55, of which you'll have a catch-up provision. If you have a 401k plan at work, you can still work with a financial advisor who can help recommend allocations for your outside held 401k plan. Does that answer your question?
I'll have to trust that it does. And we'll move on to a question from Harry. I'm 50 years old and have never saved a penny. I have assets, but they are not liquid. Where should I start?
You should start by meeting with a financial professional to evaluate what those illiquid assets are and get a valuation on them. I would be curious to know if they are tax-deferred investments or just unrealized gains. Having your money grow on a tax-deferred basis can be very helpful, but if you happen to own a piece of real estate, perhaps a rental, and you go ahead and sell it, you will not capture the $250,000 tax-free that's automatically allocated for letting you live in it. If you've lived in it for at least 2 years, or if you're as a couple, it's $500,000. And if you have over $250,000 in gains in any investment that's not held in a tax-deferred account, Warren Buffett has happily come out with a an additional tax this last year, which equals to 2.8% on top of your capital gains tax. So I would start by bringing all of your assets into a financial advisor and laying out your tax returns and having a conversation.
All right, thank you. And this question from Quincy, I'm starting so late, how can I catch up without really risky investments?
Well, if you don't have an IRA now, I would start with that and put in the maximum amount. And then make a plan for dollar cost averaging and setting money aside on a monthly basis. It's not too late to start, and again, sitting on the sidelines doesn't get you anywhere. So it's better to start right away with what you have. Even if it's just $250 a month, start now.
Great, thank you. And this, our last question from Jane. How would you recommend that I frame crowdfunding in my investment portfolio? For instance, should I allocate a certain percentage of my portfolio to crowdfunding opportunities?
I can't answer that question directly because I don't know how many assets you have. But if you are an accredited investor or have enough money that you feel that you can put aside to invest in something risky, perhaps 5% would be a good number to start with.
Excellent. Thank you, Zoe. And we're going to conclude our questions for this webinar, and I'll hand it back to Kim Kaselionis. Kim?
Thank you, Scott. And thank you, Zoe, so much for that comprehensive review of investing fundamentals. And I love that last question. Perhaps I could address it a little later in my comments. So let's talk about crowdfunding now. What is crowdfunding? Well, defined, crowdfunding is when a large group of people combine their economic power to support a project, organization, or company they believe in, usually via the internet. And we talk as if crowdfunding is new, and it is not. We have a lot of really cool technology today, but it is the way that companies and projects have been funded for thousands of years. Let me give you a couple of examples. In 1872, Joseph Pulitzer, pretty bummed that Congress was unable to agree how they were going to raise the $300,000 in construction costs to build the pedestal on which the Statue of Liberty would sit, appealed to the American people by asking them to send whatever donation they could. He further incentivized the public by stating that if they made a contribution of $25 or more, he would send them a miniature replica of that iconic lady. The gift or reward in exchange for cash is now known as rewards-based crowdfunding. Here's another example. When Benjamin Franklin needed to raise capital for a printing press, he went door-to-door pre-selling subscriptions, aggregating small dollar amounts from a large group of people to raise sufficient cash to buy his printing press. This pre-selling of a product in exchange for cash is known as rewards-based crowdfunding. I suspect many of you have either heard of or participated in some sort of rewards-based crowdfunding venture. Today, there are 4 basic types of crowdfunding models. 2 are regulated and 2 are not. We will cover the first 2 non-regulated models, donation and rewards-based crowdfunding first. In donation-based crowdfunding, the donor gives a contribution with no expectation of economic or monetary return. Perhaps a tax-deductible receipt would be helpful, but there is no exchange of any kind of a monetary or a gift. Donation-based crowdfunding is used predominantly by the nonprofit community. In rewards-based crowdfunding, as in the case of Joseph Pulitzer and Benjamin Franklin, the donor makes a contribution and in return receives some kind of tchotchke, where the tchotchke or reward value is closely matched to the value of the contribution. Now, you may have all heard of Kickstarter. Kickstarter is the largest crowdfunding, rewards-based crowdfunding platform, facilitating over $1 billion in transactions since their formation in 2009. Rewards-based crowdfunding is a great place for consumer product companies to market test their products and to raise small amounts of capital. But since there is no economic benefit derived from these transactions, it is a difficult platform for entrepreneurs to raise large sums of operating capital. Again, donation and rewards-based crowdfunding are not regulated in the United States. The next two models, debt-based and equity-based crowdfunding, are regulated and are the focus of the discussion for investment opportunities available for you. In debt-based crowdfunding, the contributor, now known as investor, lends cash to a company with the expectation that they will receive their cash back plus interest paid on a fixed schedule. The benefits of debt-based crowdfunding as an investor is that the rate of return is predetermined and the investors are senior in the liquidation to equity holders in the event of bankruptcy. Debt-based investments are a good source of current income as the payments are made regularly and investors don't have to wait until the company is sold or goes public to get their money back. In equity-based crowdfunding, the investor contributes cash in exchange for a portion of the ownership of the company, just like in some of the stock examples that Zoe had previously talked about. Investors' hope is that the company will be successful and that the investors will be able to share in the financial benefits, the profits or the gains, on the value of the stock when the company goes public at some future point. There are benefits of being an equity investor. First is there is an unlimited potential for financial gain. And equity crowdfunding enables entrepreneurs to raise capital by converting their social capital into financial capital, by inviting customers, suppliers, and vendors, as well as members from their various affinity groups, whether it's faith, golf, hiking, sailing, biking, to become part of the ownership culture of the company. Securities-based crowdfunding, in the regulatory sense, which we will discuss in a minute, is not widely legal in the United States yet, like it is in other countries around the world, but that doesn't mean that you don't have options today, because you do as an investor. So let's talk about how did the securities-based crowdfunding come to pass. Think about where our economy was in 2011 and early 2012, characterized by high unemployment because businesses weren't growing or purchasing inventory and equipment, coupled with a virtual shutdown in the capital markets, which provides financing for those growing U.S. businesses, which basically choked the life out of our economy. And all of this converging during a presidential election year. We know politicians. When it comes to their re-election, every incumbent wants to tout their successes and effectiveness by highlighting strong economic and employment figures. Well, this just wasn't happening during that period. Something had to be done about the economy. Politicians had to find a new source of capital to be invested in SMBs, our small to medium-sized businesses, so jobs could be created and our economic engines could start running strong again. Someone somewhere looked around the country and found that there was $17 trillion in cash sitting idle in American retirement accounts. And that cash didn't necessarily belong to the pension funds or institutional investors. In fact, much of that cash belonged to us, the general public. Well, that was all fine and well, except for the general public, because of the securities and exchange laws in this country, are prohibited from participating or investing in private equity securities, those privately held companies that create U.S. jobs. In order for Congress to get what they wanted, tapping into that new source of capital, they were going to have to change the existing securities laws. And in April 2012, the Jumpstart Our Business Startups, or JOBS Act, was born. and the provisions contained therein represent the most significant deregulation in the securities and exchange laws in nearly 80 years. And the Jobs Act does several things, much of which we will not cover today, other than to say the provisions fundamentally change which companies can raise capital, who can invest in private capital, and how those investors can be marketed to. I am going to spend a little time on Title III, however, because Title III is the classic crowdfunding rules. And Title III basically does two things. First, it defines which private companies can raise up to $1 million per year from an unlimited number of unaccredited investors. Again, they define the provisions under which private companies can raise up to $1 million from an unlimited number of unaccredited investors. So the second part of that is defining the parameters under which unaccredited investors can participate or invest in private companies, a privilege that has historically been reserved for the wealthy few. And while the Securities and Exchange Commission has yet to release Title III regulations, which is why, as I stated previously, crowdfunding in the regulatory sense is not available as of yet, many states, including the state of California, are in the process, have looked, or have enacted their own statewide regulations. In February of this year, AB 26 was introduced into the California House of Representatives, and it passed in May 75-0 with no opposition. This bill, which in essence mirrors the federal SEC Title III rules with a few enhancements, will make it legal for any California resident to invest in any California private company within the prescribed guidelines. This is very significant for our local economies, for small businesses, and to the general public who have historically been precluded from investing in those early stage investment companies. This map illustrates which other states have also considered, have passed, or in the process of considering their own crowdfunding regulations. So let's talk about who can invest in private companies today. There are three basic categories of investors as defined by the federal and state securities laws. The first is the accredited investors, which Zoe alluded to earlier. This is the top of the wealth food chain. Then there is another group called the qualified investors, followed by non- or unaccredited investors. And who can invest in each offering is dictated by the type of security exemption each company chooses to raise capital. And this information can be found in the private placement memorandum and on each of the Tombstone marketing information sections on our website. An accredited investor is someone characterized as an individual who earns over $200,000 a year or has net worth excluding the equity in their home of $1 million, or a married couple who has annual income of $300,000 or more. Qualified investors are those characterized as earning $100,000 a year and who have net worth of $250,000 or more net worth outside the equity in their home, or they have net worth of $500,000 or more, excluding the equity in their home. And then there is the non-accredited investor, basically everyone else who doesn't meet the definition of accredited or qualified. In today's federal securities exemptions, 506B allows a company to raise capital, inviting up to 35 non-accredited investors per offering. So theoretically, somebody or you can raise capital from the members of your community, those people who are your customers, suppliers, and vendors. You can raise up to $1 million using this exemption today. Now we're going to talk about a few of the opportunities that are available for your investment dollars today, but I have a few additional notes. In addition to having access now to a host of early and late stage investment opportunities that have historically been denied you, there are many more advantages of crowdfunding from the investor's perspective. Crowdfunding can help you mitigate losses through diversification because many of these opportunities have lower investment requirements. In today's private equity world, many of the investment minimums start at $25,000. In the crowdfunding world, you can find investment minimums starting at $1,000. Crowdfund investing also provides many other benefits like no fees to invest on many platforms, ease of use, transparency, no geographic restrictions, and the ability to invest with your self-directed IRA funds. But don't be fooled. Investing, irrespective of what type, whether you purchase publicly traded securities through the New York Stock Exchange, penny stocks, or bonds, it involves risks. And private equity investing is risky. So be sure you read the business plans, review the due diligence documentation, ask questions, particularly as they pertain to risks and exit strategy. At Breakaway, we reviewed this data from the lens of bankers. This is what we want to see and we make this information available to you once you have registered at no cost on our platform at breakawayfunding.com/investors. Additionally, we invite you to participate in our monthly pitch parties where entrepreneurs will present their investment opportunities and where you will be able to ask questions directly to them. Our site is transparent and secure. All of our deals are conducted through a broker-dealer, someone who is licensed by FINRA, the governmental agency responsible for monitoring all licensed securities dealers. Which brings me to my final comment before we review two current investment offerings. And that is, not all crowdfunding platforms are equal. Not all platforms use a broker-dealer intermediary who helps ensure that the companies raising capital are who they say they are and have disclosed everything about the company they are legally required to disclose. Know who you are investing through before you begin investing online. So now it's time to jump into a brief review of two of the current investment opportunities available for you on the Breakaway crowdfunding site. Let's take a look. Michael Rodriguez founded and operated the Cadillac Bar and Grill in San Francisco in the 1980s. He ran and operated it for nearly 17 years. For those of you from the Bay Area, you may remember it well. Very popular and financially successful venture. The restaurant was closed in the 90s when the Moscone Convention Center expanded over it. Now Michael is bringing the Cadillac back. Conveniently located in one of the most exciting new high-tech concentrated areas in San Francisco, the Cadillac will operate out of the Twitter building at 9th and Market Street. Characterized by high-density housing, fast-growing firms with thousands of employees, and close proximity to other bustling venues such as the Civic Center Plaza Theater District, make this location optimal for success. BART and other public transportation provide a convenient way for patrons to enjoy dining or drinks hassle-free. Michael is raising $1.5 million in equity ownership. The minimum investment is $30,000 and is available to accredited investors only. For more information about how to invest in Cadillac Bar and Grill, please visit our site at thebreakawayfunding.com and look for the Cadillac Bar and Grill icon. Additionally, for those of you available tomorrow who would like to meet Michael, you are invited to a pre-construction party at their site at 9th and Market. Our next opportunity is Paellas. Paellas Bar and Boutique offers exclusive jewelry, clothing, body care products, craft beers, and wines from Brazil in a festive, lavish, and joyous environment. Paellas is bringing Brazilian lifestyle to consumers in the United States. Paellas is a unique shopping experience combining taste, sights, and sounds of Brazil. Shoppers can browse product lines while enjoying appetizers, drinks, and music in the full immersion of Brazilian lifestyle. Events such as live music, dance recitals, and other cultural demonstrations and festivities will hold and draw customers. Brazil is entering a market trend as they'll be host to the Olympics in 2016. High-profile celebrities like John Travolta, Jessica Parker, and Katie Holmes are advertising Brazilian goods, which helps bring consumer excitement and credibility. The founders of Paellas are raising $500,000 in straight debt with a minimum investment of $5,000. These notes pay 9% interest per year and mature within 60 months. For more information on how to invest in Paellas, please visit our website and click on the Paellas icon. Investors of all categories are welcome. Remember our 506B? Paellas is offering their investment through the 506B securities exemption. That concludes our presentation today. We hope you have found the event informative and relevant. But before we sign off, a closing thought. Like never before, you have a chance to get in early on opportunities that are meaningful to you, help diversify your investment portfolio, and make a difference in your community. The question is, how will you take advantage of this new marketplace? I personally invite each of you to become part of the ownership culture of these and other exciting companies raising capital through the Breakaway funding portal. It's simple, it's fast, it's free, it's secure, and it's compliant. Sign up today at breakawayfunding.com. And with that, I would like to thank Zoe Sexton of the Putney Financial Group for helping us to take the first step in becoming a more confident and informed investor. We thank all of you for joining us. We welcome you to our investor community, and we look forward to seeing you next time. Thank you.